You think you have $50,000 in savings. You're wrong. If you use that $50,000 to buy a rental property, you actually have a mortgage, a tenant, a broken water heater, and a second job. If you use that $50,000 to buy index funds, you have a boring spreadsheet that will make you rich while you sleep. One of these paths is a trap designed to make you look smart while draining your bank account. Today, we are going to prove why the real estate always wins mantra is one of the most dangerous myths in personal finance. Let's set the stage. We have Alex and Jordan. Both are 25 years old. Both earn $55,000 a year. Both just saved $50,000. They have identical lives except for one decision. Alex uses that $50,000 as a down payment on a $250,000 rental property. Jordan puts that same $50,000 into a total stock market index fund and sets up an automatic $300 monthly contribution. On day one, Alex is the king of the neighborhood. He has a tenant paying $1,800 a month. His mortgage is $1,330. He tells his friends he's pocketing $470 a month in pure profit. He feels like a genius. Meanwhile, Jordan checks his brokerage app. It says $52,000. He tells his friends he's investing. They stare blankly. The social pressure is immense. Alex looks like a tycoon. Jordan looks like a nerd. But here is the trap. Alex is not making $470 a month. That number is a hallucination. Year one brings a leaking roof. That's $2,800. Year two brings a broken HVAC system. That's $5,000. Year three brings a tenant who trashes the place and stops paying rent. Suddenly, Alex isn't making $470 a month. He's paying $200 a month to own a headache. And this doesn't even count the 15 hours a week he spends on late-night phone calls and weekend repairs. Alex is working a part-time job for negative pay. Meanwhile, while Alex is unclogging toilets and managing tenants, Jordan is doing absolutely nothing. He isn't picking stocks. He isn't watching CNBC. He's just waiting. Because Jordan set up automatic contributions, the compound interest machine has kicked in. By year 5, his portfolio is over $135,000. He hasn't touched it. He hasn't sweated over it. By year 10, Alex's property is finally worth $350,000. He has $180,000 in equity. On paper, he's a millionaire in training. But his actual cash-in-pocket profit after 10 years of repairs, taxes, and mortgage interest is barely $30,000. Meanwhile, Jordan's portfolio has quietly grown to $180,000. He put in $86,000 total. The rest, the nearly $100,000 in profit, is pure, effortless compounding. Fast forward 20 years. This is where the math gets brutal. Alex's property is now worth $500,000. He's finally paying it off. His equity is massive. But look at the cost. Over 2 decades, Alex spent thousands of hours managing the property. He dealt with the stress of eviction notices, the panic of broken pipes at 2 a.m., and the risk of putting all his money into a single house in a single neighborhood. Jordan's portfolio, fueled by the unstoppable engine of compound interest and his consistent contributions, has grown to nearly $600,000. He owns shares in the top 500 companies in America. He has 0 debt. He has 0 tenants. He has 0 2 a.m. panic attacks. Here is the truth that real estate gurus hate. Real estate only wins if you treat it like a high-stress business, not a passive side hustle. If Alex had treated his property like a business, hiring a property manager for 10% of the rent, budgeting for every single future capital expenditure, his returns would have dropped to 4%, which is worse than the 10% average return Jordan got from simply buying the market. And here is the final psychological threshold. Real estate makes you look rich. Index funds make you actually rich. Real estate gives you leverage, the ability to use the bank's money to build wealth. Index funds give you freedom, the ability to walk away from a toxic job because your wealth is liquid and sitting in a brokerage account, not trapped in a foundation of a house. The next time someone tells you that real estate is the only way to build wealth, ask them one question. Did you factor in the 2 a.m. phone calls and the broken water heaters? The answer is usually no. Stop trying to look rich and start being rich.